Everybody, I'm Dan Hussey with Zaner Ag Hedge, bringing you our strategy of the week update here for February 9th, 2023. Remember, trading futures involves risk. It is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. But of course, my number there on the screen, 312-277-0110. Find me on Twitter, on Facebook, right here at Dan SOTW, and or shoot me an email at dhussey@zaner.com. Always look forward to speaking with our traders out there and our viewers at home that are following along on some of these ideas and trends that we're trying to ring in and tackle. These are not the easiest markets to trade. We have lots of volatility. Well, it depends on where you look. Corn is not very volatile right now, but generally speaking, markets have been very volatile over the last couple of years, right? And so now at a period where things have kind of gotten maybe a little sleepy, you can't fall asleep at the wheel because boy, there's a lot that can happen in a very short amount of time, isn't there? Okay, so we have a bit of risk off in the markets today. Let's kind of begin with the S&P 500 real quick. Okay, we were pulling back there into a potential extended long. So this was an old breakout from the 40-35 area to the new highs after. We got a reaction off the 50 to 61.8 line. We got a reaction off of trend line support. The market was then maybe nesting into another 50%, same thing, and today's the day that they really broke through some of the bulls' potential. So near term here on the 4-hour chart of the S&P, it does look like we are breaking potentially for a move down to the 40-50 area or the full 50% of the whole swing from 37.88 up to highs. Now that just pulls the market back into a retest of that broken trendline resistance. Right, if you go out to the daily chart here, that broken trendline resistance against the highs, and certainly we could look at all of this this entire rally so far as a 50% retracement short off the highs in the S&P around 4,200 that is currently holding as resistance. But when we dial down and we think, okay, we already reacted off that level, we held the full 50% long off of that 3,500 low. We've talked about that level in the past. We broke through that trendline resistance, and as we broke through the trendline resistance here, right, it wasn't just a clean break, right? There was this whole series of breaking through it, or knocking on it, falling down, knocking on it, falling down, knocking on it, falling down. But every time we started to fall down here, we diverged, right? The lows were higher, and the market caught a bit up into testing resistance once again. Then we finally pushed through that resistance, and we came back to test this support, pressed 2 steps forward. This could ultimately be, you can make a case that this whole this whole correction right now is really just 2 steps back. In a stair-stepping kind of pattern higher. Could the swing from 4,000 here to highs, be the 50% they're holding? Yeah, and that's probably the most aggressive, I would say. It's this high here that we broke through the old resistance trend line with. We tested that resistance trend line. We tested a new supportive trend line with, and then the market came through those highs. Again, right? So now that's to me is 2 steps forward, 1 step back, 2 steps forward. This is all part of 1 step back. It's just a little drawn out. Now we do have those warning signs, right? The multi-day lows taking out, slipping back below 4,100. Certainly 4108, this old high, the high from January, not a good sign considering we went up to a new high for January and a new high against December. We're at now a new 3-month high with the 4208 highs on this chart. However, pullbacks to 44,000 could just be the market causing some pain to the bulls and the breakout buyers of this trend, and I wouldn't be surprised to see that in this near term. So I'm still cautiously optimistic. We're breaking through more trendline resistances than we are supports. And most of this, right, we can draw a supportive trend lines at a few places, below the lows of this chart that gives us, new support below us that all seem to align with Fibonacci retracements and some of our old higher highs. So we've got some good confluence of fibs. The market looks very technical. I say confluence of fibs where, they overline with other indicators. But today did seem to be, a failure after an inside day of price action, right? We had a bullish engulfing day. There on Tuesday, then an inside day, and now we have a lower low and lower high Today, you can see the highs of the day and the lows with the pink and the purple, or the purple and the blue, light blue lines there, the dark dotted red lines and the dark blue lines and the monthly high and low. But this quickly allows me to gauge where we are right in those kind of time frames. Well, we definitely have a range here between 4,200 and 4,100 kind of carving out, right? The highs to lows in the month is basically 4,000 to 4,200. So at 4,100, you're very much just inside the monthly type of range. Kind of testing on and staying, and honestly testing, trying to stay on the supportive side of that second upper half of do you guys see what I mean? Like if this is the lower half below 4,100, we're trying to stay above 4,100, right? And we've been ranging up there ever since. So I'm not willing to say that we've broken it and it's just short for sure, down into 40, a retest of the lows of the month, and that could certainly take us lower towards 4,000. But okay, there's definitely some reasons to be concerned here, and we'll need to watch closely if today is just a gotcha trade. I would say trading back above 4120 with some conviction would be that capitulation off of this low. So a little risk off today. I think that was also compounded in the oil market here. The crude oil, March sweet WTI crude. I want to flip over actually to the daily chart of this one first. And we'll get into the row crops here in a second and kind of what post WASD, markets have left us with. I don't really think anything in the WASD report is reflective of what's in the markets right now. In fact, I feel like it's a bit of a squeeze on it. But daily crude, right, actually was a little bit more bearish earlier when I was watching and making a decision kind of what to talk about and where to look. That was like an hour and a half ago. It looks like crude has obviously come up off of its lows of the day here rather vigorously, which, okay, good for the crude bulls, but we still have a red day here. We're still below that 18-day moving average up at 78.62. Now, granted, that was a level we slipped below at the start of the month, and we've been below ever since. We're climbing back above that 55-day moving average right around 77.50, and it's 100-day above us at 79.50. Seems like a natural place for short-term resistance to continue to fold. Crude very much, a big range here between 72 and 82. $10 ranges in crude seem to be where we've been living. And that goes back much further, right? We can go back and let's actually pop onto a continuation chart here and kind of go back here, to last year and such. Here's that 84, a bit of a $20 range perhaps, right? That it traded through, but we had $10 ranges kind of carving out in crude before that. We then broke out to that new high here in 2021. 2022. It was early 2022, right? And then, we basically had $10 and $20 ranges that we were fighting between while the market slowly urged higher. You can see it here between having head from 100 to 120. There's some 120 to 110 swings, intermittently in there. And it's been in this kind of like stair-stepping 20 down, 10 up, 20 down, 10 up, 20 down, 10 up kind of range this whole way down. So not much about crude's price action has changed my conviction that it couldn't roll over and just continue lower, because it's very much still, I think, continuation of this downtrend. Yeah, we definitely have broken, some of these downward sloping trend lines that, depending on how and where you draw them, we looked like we were breaking them, I should say, and maybe even came above them. But the fact that we're kind of still holding below some of these less aggressive ones, like this one. This is the one I can't get it to lock on the top, the high there, but you guys can visualize it, right? It's almost that blue line too, which is the 100-day moving average, kind of as resistance. So until you're above that 81 area, 82, right? I don't know if we can have a lot of confidence in the crude really taking off at this point, and it's a little worrisome at this time. Just for the general risk on, risk off. 1 second. Okay, sorry about that. So anyway, again, a little bit of a range here, kind of like we had in the past. That can always resolve lower, but certainly, okay. The fight isn't over. A couple days ago, it felt like crude breaking below trendline support and below testing below the 72 area, and giving a shot potentially at hitting 70 again. That felt very bearish, and for the time being, though, it looks like crude has bounced back. And even on the day, let's break down that 4-hour chart now. Um, Maybe an hourly chart at this point. And it's really hard to sink our teeth into too much here outside of, short-term trend lines break. There's definitely a downward sloping channel here. Intraday, right? These are just straight up and down moves for 5 and 6 handles. It's pretty, unless you're willing to risk $5 in crude, it's almost like geez, I don't see anything day trading wise you can do except for maybe hop in on the trend. So, coming off this low, we very well may be forming now some kind of channel ourselves. But, you can't discount the ability of a market to pull into a 50% long if it wants to. There might be a much more aggressive level going on here that, we have one pull, two pull. I'll have to do videos on how I do that. But basically, if it goes higher from right where we are, we need a way of justifying the algorithm that did 2 steps forward and 1 step back. And what we have to do is we have to go back and mimic the pulls it did, and then you can start guessing where the next one might be. It's just a matter of tracking footprints in the sand, right? So I would not be surprised, though, to see crude to roll back over. Look for that 75.50 to 74.50 supportive area if this market wants to go higher, and then a move from there back up to 80.50 would be, move from 75 up to 80 and beyond would I think be the signal that a market has shifted from 2 steps down, 1 step up, 2 steps down, 1 step up, 2 steps down, to now doing 2 steps up, 1 step back, 2 steps up, 1 step back, right? And that's what we're really looking for in the near term of any kind of trend reversal, in my opinion. Okay, let's move on to our row crops. I guess let's start with corn. Finishing down 7 cents on the day in the March corn. Before we expand out, let's look at the price action just of the last couple weeks here and just appreciate how silly it looks because it's all within like 10 cents. And the last couple days, it's gotten even tighter. Anyway, we had effectively... it's very hard, I guess, to see, but... Okay. We had, kind of a reversal day. Went below the 18-day moving average, tried to get back above it. Then we had these inside days. In other words, you had 2 days worth of price action that was inside a prior day, right? If you look at where the high and low from February 3rd is, February 4th was, or 6th was completely inside that day. And then February 7th was completely inside that day. We then had an outside day, which can spark a potential, signal for the market to go one way or the other, of a green day. Then we wanted to see follow through and a break above the 680 area to confirm that outside day reversal higher was occurring. It didn't happen. We went up above it, and we quickly came back down inside. Didn't really spend much of the day out above that area, and pretty much just sold off right on down to and through the 671 lows of that range. It's about as bearish, I guess, as a gotcha head fake or a bullish now, a bearish engulfing candle to the entire range, an outside day, I should say, to the entire range to yesterday. So we go from compressing price action to now expanding price action with the momentum pointing down. We did hit oversold on the daily RSI, but that almost means nothing because of how tight we've gotten. This is an oversold. That could remain oversold, for a period, probably even down to 650 if it really wanted to get there. I'm not saying we're going there, but if we're taking a step back for the start of the year, the range has been between 650 and 688. It's not like a huge range. And you take that step further, the range has been, and that's the continuation chart. Let me get to the regular daily chart. There we go. I didn't want this line on there just yet. But there you go. The range then opens up, 687 to 660. Range then, opens up a little bit to 635, up to 710. But generally speaking, right, we're talking about a range in corn, right? There's no other way to put this. Downward sloping trend lines, however, are starting to break. We're starting to break above them and hold them as support. And even today's pullback was really just a test of a 4-day low, as well as that broken downward sloping trend line from our seasonal top back last May through the seasonal top in October. Yeah, could be a market just breaking through resistance and testing as support if you really want to get down to it. Trend lines against the lows, the similar lines are still holding. I mean, that doesn't really come in until 660 at this point on the March corn. And 665, excuse me, is where our 55-day moving average, until today, was the only moving average that was below, was the lowest moving average, and I guess it wasn't the only one that we are still above. As today was the day we failed to get above that 18-day moving average at 677, right? That red line on the chart here. We fell back down to test the 200 and 100-day moving averages at 675 that were there together, and now we're back below them. So unless this market snaps very quickly right on back to 680, next support is, below us down here at 665, 660, and really, right, you could open the door down to 650 and below, because, we would just be expanding that range and changing where this downward sloping trend line is. I don't necessarily still believe that's going to be the case, because I think even today's expanding price action is still kind of it can be faded, right? Or if it gets faded by the longs, I could see how this was a further you pull back the rubber band, the further it flies experience. But until then, today's close was not a good look on the daily chart in terms of the candle, but it didn't do much damage to many of our technical indicators that we've been basically wrestling over for the last couple weeks. So I just kind of remind myself that it's still a very tight range. And at this point, many I know of my clients, and certainly much of the work I've been doing with clients, is to try to use short-term put protection in this environment if we're long futures, or I guess for hedging purposes, there's certainly ways to get a floor in here. But the idea was, going into this WASDE report this week, my main strategy that I was working with clients for risk management was let's pull stops, in any futures position we have. That could be if you're long or short futures and you wanted to somehow ride that risk through a WASDE whipsaw with a stop, with some finite risk in the market. We would do that with, buying a put for a long futures position or buying a call for a short futures position, right? Because those puts and calls then act like a stop that we can't get stopped out of. And, we go in and we utilize weekly options that expire at the end of this week. We were using those, the 1510 puts in the beans and the 670 puts in the corn. I think I mentioned those potentially yesterday. In our WASDE webinar, and I might have mentioned them. No, I'm sorry, in the pre-WASDE strategy of the day that I did, because I felt those were good ways to manage risk in this environment. You basically had to stop right against almost the lows of the month for corn, and for soybeans, pretty much, for both of them, for 6 and I think it was like 6 and 3 cents respectively for beans and corn. So for our chart though, for March corn, again, not much to say other than the breaking above this trend line and kind of a regression back to the mean of the ranges we've been in. The range for the month right now, 86 to 70. The range from last month, 88 to 48. Again, we're kind of staying above the higher end or the top 50% of that range. So I'm not convinced it's over yet for corn, but I'm getting frustrated as can be. I really want to see that pushed back above 681, and potentially this time up is the one that you could actually buy a breakout of 680, 681 on momentum. But instead of that, if we're going to go higher, and it kind of needs to now, right? Your March options go off the board in 15 days. A March 680 call in corn. Oh, come on. You don't want to give me quotes. There it is. So it went out the day at 8.25 last. Yeah, this bid offer is not very accurate, but I would say even if 4 cents, excuse me, the 680 call here for about 4 cents. That was just back to highs of the day, ladies and gentlemen. I mean, I don't know. In this environment, I find volatility very low for corn. You know, this implied the vol, the Vegas are very low. So I have a tendency to really want to buy options in this environment because to me, intrinsically is the wrong word, but there is value, right? Because I believe that we're about to see a period of volatility. And so I think this 4 cent option is undervalued. And that doesn't, right? It doesn't make sense if we go down, you don't make money. But I think these options could be very, much more expensive if we start moving around a lot more. But unfortunately, there isn't much time on the clock for March, so it's not going to matter. It's got to be right or not. But the 680 call for 4 1/8 pennies here seems like a decent proposition if we want to take a look at the market going straight up. Otherwise, to the downside, that 660 put seems like a really good put to use in the meantime if you're not using the 670, through the end of this week, which very well could get we could close below, and that's a stop out, right? But the 660s through next week for 3 5/8 cents. If you think we're going lower, I think we're going to probably be above or below that 10-cent range by the end of next week or 2 weeks from now, right? This isn't even right the end of next week. This is 2 weeks from Friday, and corn. Into the end of the month, I think we'll be pushing above 690 or back down to 650. Excuse me. So from that perspective alone, for 7 cents to own a 670 call and 7.5 cents to own a 670 call and a 660 put, with the hopes that either one of those would be worth 20 to 25 cents, not a terrible totally unbiased directional trade. And I'm pointing this out only because the only time I'd ever tell you to buy puts and calls at the same time is one, when we were getting close to expiration where, okay, there's 2 weeks left of time value. That's not, you're not getting eaten alive by time value and buying these. It's because of how condensed this market's got and how compressed we are. And the compression that we saw the last 2 days, right? And then now the expansion we're seeing. I mean, pick a side, right? Buy the 680 call or 660 call for just a couple pennies, or put, excuse me, the 660 put or the 680 call, spending very little to maybe have a shot over the next 2 weeks. And by all means, you could also go long the futures and use that put, or go short the futures and use that call as your risk as well. There's all different ways, right, to challenge and change this, to use these, I should say, all of these contracts as a tool. All right, let's take a look at soybeans now. That was a lot more about a corn market that I wanted to say that hasn't really done or given us much to look and sink into. Okay, March soybeans. I mean, yes, similarly to corn, we have somewhat of a range, but this is more of like a rising wedge. Today's price action was a higher high and a higher low when we closed the doji right on that 18-day moving average. I mean, we just have reversion to the mean in the beans is all I can say about it. We've got some upward sloping trend lines that continue to hold. We've got trend channel resistance that's holding. No downward sloping trends against the highs are holding at this point, right? This is an uptrend. It's very choppy. It's disgusting. It doesn't look like clean and beautiful how we want trends to look, but who cares? A trend is a trend. And we have traded now, basically held ourselves from going oversold. And there's room to the upside under the daily RSI, up to overbought. So if we want to push through that 1335 high, I think there's plenty of room to run on the charts, to the upside in terms of where next resistance could be. Plus, we're not anywhere near overbought. So, there's no reason to think, sellers, we need to unwind, a massively long position in terms of momentum. That's not necessarily a comment, though, on where commitment of traders are. Again, we're holding above that 18-day moving average, and that seems to be the reversion to the mean in the fight that we're seeing in the near term. 55-day moving average down below us at 1491. 100-day crossed over that 200-day for a nice little golden cross there at 1460 currently, with the 200-day down at 1455. So I think it's important now to consider, the old contract highs as the potential next pushing point that we could see the beans head up to. On our daily continuation charts, however, it's kind of funny, when you look at a chart of beans like this now, isn't it? With the March beans and then the current front, whatever the current front month future is, as a continuation chart, because it makes you kind of really, to me, it makes you realize how we really are right now, just right in the middle of the range of prices we've seen for beans for the last 3 years, aren't we? Right? We've seen it pushed up to 17 and almost to 18. We've seen them as low as 12 and 13, and we are right in the middle of that range here at 15 to 16 bucks. And I think that's a reminder to us all of the new normal in terms of the new normal still really that is still really that is currently dictating, right, what prices are kind of doing. It's where we're finding a happy medium, and there's a few different continuation charts you can look at, but the point being is that we've been higher, we've been lower. The market doesn't necessarily look, we're trending higher still. And when you look at it, going back to 2020 through today, it's, okay, this is a market that just continues to make higher highs and higher lows. And I think that's going to be, true as you dial down into individual contracts as well. And we're still seeing that, right? We're trending towards contract highs in March beans. Daily spread markets here for the old crop, new crop beans. We've been talking about these a little bit. We peaked on the July NOV spread here at just shy of 160 over. The highest high here at it won't let me get there. 157, pulled all the way back to 131 already. We're back below that 18-day moving average. Yeah, I think just from a, whoops, that's not the chart I wanted to see. There it is. We've pulled back to this old contract high at 133 and held it. If we stay below the 18-day moving average, certainly we could see, them still continue to try to build carry in, which is something I've been looking for, and honestly, I think could continue to be something we need to talk about here as we push, as the market could see a pullback towards, a dollar over. The March to November bean spread, which is expected to be a little wider here, has traded to highs of just shy of $1.80 over, pulling back below that 18-day moving average. Again, I could see a pullback towards a dollar over 120, okay, even to 140. Probably still, I think it needs to pull back a little bit more in terms of unwinding, the inversion that we've built into this market. And I really will start really focusing on this July NOV spread, as that's really the, that's the big kahuna, so to speak, right? That's the one, in my opinion, that really matters at this point in time. Or it is the one that dictates our whole old crop, new crop spread, roll, trading, positioning. Yeah. Anyway, March beans. Let's take a look at that 4-hour chart. Again, pretty choppy. Starting to get above that 1500 area. That was that old high we had from the summertime months through September. finally broke above it, kind of like corn breaking above its sold trend lines, has this fight over the trend, but generally we're, still building up against resistance here. I feel like these markets are powder kegs, just boiling, just getting ready, or pressure cookers getting ready to do something, right? We're building up all of this energy in here, and it's grinding and grinding and grinding, and it's going to pop the top or do a sudden drop, something, right? Trendline support against the lows can be clearly seen coming in at 1500 again here. So today's down, sell off. It's still very much inside the, prior month's highs. It's still very much, we made a new low for the month, but it's a 1543 to a $15 low range. That's only about half the range from our 1549 to 1460 range from last month, and the even bigger 1537 down to 1432 range, a full dollar range from December. So, the 40 cent or less than 38-cent range we have right now, about half of what it was last month and a third of what it was the month before that. So again, range is tightening up. We have room to the downside before we break below prior month's lows, yes. Next supportive area is at 1480, and you don't want to see it test that 1460 low from January. But while we're above 1500, and we're putting pressure on 1530, if it breaks to the upside, we're marching higher, breaking out of a pretty big, in my opinion, pretty big resistance area that it, should hunt out that 1572 contract high. Like, I don't see why we wouldn't get to that point with a solid break here on the next push higher. If, we're holding above 1500, we continue to bottle up and we just go, right? That's the most bullish situation there is. But you can't discount that, hey, line in the sand here at 1500 in the near term. Below that, 1480 is next, 1460 is not far behind. And then you start to slip all the way down to like the 1420 and 1400 areas. You guys see why I see those levels with the old lows of the prior months there. And then when you just take a step back, right, it was a big supportive area in September from 1400 down to 1360 that we based and kept putting pressure on resistance from. And now we're breaking through that resistance, starting to actually hold that old resistance as support, which means we should find new resistance, which I think is, more towards the 1580, $16 mark, before doing another one of these types of sideways moves. I think we have higher to go. Okay, so I haven't lost my faith in the bullish appetite that I thought these markets might have. Fundamentals are still there, right? Nothing's changed from this Wisely report dramatically. If anything, it helped me solidify that, hey, South American production isn't as, grossly, good for them, but isn't as massive as it was or expected to be. But this Wisely report really didn't do anything for me in terms of sell me on why I need to be a bear or a bull. It's just now that it's out of the way, I can focus on what the charts are saying, and I think the price action in the last few days are a result of a lot more technical trading coming into play, and you start to see, when charts start to become more technically traded, stops for technical traders start to get hunted, right? And we start to do things that I think we've seen in the last couple of days, which is make price action look very frustrating until all of a sudden it isn't. So hang in there. We've been through this in the past. All right, Chicago, KC, and spring wheat here. Chicago wheat trading down 7.5 cents in the Chicago contract. And here it is, the KC wheat trading down 17 cents on the day. That is spread trading right there. We've been following these contracts, these wheat contracts. We've been following the protein spreads closely. And look, it was a spread day, right? And if anything, I think that this is the pullback that we are wanting to see in the wheat that maybe is now going to confirm or give some potential for, a reversal. We'll see, because I don't love where the outrights ran into resistance so far. They're very much like, a chart of crude oil right now. If you look at these charts of wheat that I'm just kind of rolling through, you can see if you describe, from left to right here on this chart, we break below most of those moving averages and some kind of downtrend, holding below downward sloping trend lines, right? And then all of a sudden, the market starts to try to break above those levels, but generally gets caught in a range at lows. And there's your chart of crude, right? I think a very similar type of, well, I guess this is the chart of crude I wanted to show. There it is. That's the one, right? Downward sloping trend lines. You keep breaking below them, and now we're kind of in this range at lows, right? This is not so different than the charts here. There we go. There we go. Now you're seeing the kind of what I'm seeing, right? We had that Ukrainian news headline, inflation driven blow off top. Then the markets kind of fell apart. Crude oil was no different than wheat here. Energy prices and our basic foodstuffs all moved together. Um, and nevertheless, Chicago wheat here actually heading a little less to the downside than KC wheat did today. And that caused, that KC Chicago wheat spread to unwind somewhat. And that's kind of what we were looking for. We expected either Chicago to be better bid than the KC, or in the situation that we see here, KC get hit a little bit harder. But let's just take a look at those wheat spreads real quick. So the KC Chicago in the July contract. Okay, upward sloping trend lines now that we've been holding down around the 69 area. This 100-day moving average, I think, is much more enticing to me than the 55-day, but you can see the 55-day has been respected, and anytime we broke below it, we've only stayed below it for very long. So break below the 18-day moving average is the signal to get out of your longs, and then the trade is to look for the move back to the 155-day moving average. That's just what this trend is doing. So we have that 18-day moving average has broken. You're out of your longs if you're in them for whatever reason. We're testing back to 77 here, or 70. So somewhere between 77 and 70 is maybe even as far down as 60 if it really wants to test this old low. But okay, I could see this chart unwinding another 10 to 15, maybe even as much as 20 cents in this July on July KC Chicago wheat spread, and I'd probably be a buyer on it down close to 70. The March on March, which doesn't have much time left but is unwinding as well, hasn't come into its 18-day moving average, so maybe even an opportunity to bear spread it in the near term, but a move with stops against the highs, a move down to 114 or maybe even lower down to into the 90s. But at this point, I would be looking to buy the July on July because it's at 80 cents, right? And the March on March went to $1.20. So, this chart right here, what this looks like right now, this move from 50 up to 122 down to 80 of the March is kind of what, I would expect right now from this July. Back down and then, up to 120. So that's just a food for thought there. Okay, let's get into our daily levels, and I'm rambling on. Downward sloping trend lines for wheat. We started to break above it a lot like the corn. We're above the 18-day. We're above the 55-day moving average. That's on our continuation chart. Very similarly, today was the day we tried to fight our way back above that 55-day moving average there at 758 for Chicago wheat. We came back down to tested a support. 18-day down at 748. That's my line in the sand in the near term for the Chicago wheat to head higher. 740. I want to see a clear break below that level and just this be a head fake. But until it is, I'm rooting for the bulls, so to speak. Because I think that there's an opportunity here for this trend reversal to be happening. KC wheat, I don't love that we found resistance there right into the old highs here at the $9 mark and that 100-day moving average. So a pullback here down to 862 to the 18-day moving average, and the 55-day moving average I don't think is out of question. That would be about, I'd say an 850 is about where 50% long is off the lows here too for KC wheat. So kind of waiting and looking for that pullback now as well. And then today for spring wheat, not much going on. Stayed above the 18-day moving average. It's fighting to stay above that 55-day there too. But this is a outside day, red day for the spring wheat as well. So kind of some bearish signals after coming off of overbought conditions in our daily RSIs for the wheat. They've all been overbought for a little bit here and starting to roll over. So I think it's time, right? We're seeing pressure and a reason to think there could be a pullback now on these charts. We need to respect that. And hey, there's even been bear spreading other places in the wheat complex that we need to be aware of as well, right? Not the end all be all, but whatever. It's given us some clues and some things we can look into. Not much going on the short-term time frames there for the wheat. I think I covered the levels there to watch. Down in the 740 area on that Chicago, and down towards that 860, well, 860 to 850 area in the KC wheat. Let's just call it there. All right, now let's take a look at cattle and hogs real quick, and maybe a quick look at cotton, and we will get out of here for the week. April live cattle, higher high and higher low, but a doji finish on the day kind of keeps us back inside the range we are. But generally speaking, probably just a pennant at highs. We've unwound the overbought conditions, so there's definitely room to push higher if it wants to. But watch, because a break below 163 probably opens the door to a test of that 18-day moving average. And then just staggered below us are these other moving averages to consider, and upward sloping trend lines that come in, with I think where support would be generally above the 160 area at this time. So still bullish above 160, and looking for maybe even a pullback into that area at this time. Not much else to say there. It's a trend higher. Let's look to hop in it. Feeders, I definitely want to see this March feeder try to push above the 189 area and get to 190. Price action today was not a higher lows, lower lows and lower highs, but it was a capitulating low where we closed it with a bullish, kind of a bullish close there. So we've broken above our cluster of moving averages here for the March contract. If we look at the daily continuation chart though, for March feeders, you can see how we've basically been, above many of our longer term indicators here and are very much trending higher. But we're looking for the March contract to prove itself and to now get to new all-time highs or new contract highs for March, which, the 188 to 192, let's just call it the 190 figure, is currently kind of, in my opinion, the breakout level that we're going to be looking for in this market. We are overbought on the daily RSI. That's, I guess, okay. I'm just looking for some confirmation, or would have liked to have seen, feeders lead the way here to the fats, but, it is what it is. April hogs, just been an ugly chart. I can't be a buyer again until we're back above that 18-day moving average. It's just very clearly down, defending the down channel and trend right now, even though I think that even from a, continuation standpoint, when you go back on hogs, this looks like a giant range that we're just back into, the nearest level of major support around the 80 figure. With that being said, though, pork cutout values for April, there they are, also trading down and lower, but maintaining about a $6.90 spread, which is pretty wide still. And we'll take a look at this pork cutout spread at another time. I'm trying to get the contracts down because it is something that has become more widely traded, and it's been a very interesting to watch the cutout to hog spread as well as the cutouts themselves. It's another interesting opportunity to trade. Okay, so cotton today, kind of an okay day. Again, we're still very much in the larger range we've been in. But today was the day we're trying to still wrestle and get above that 18-day moving average, which I like. We're above that 55 and 100-day with a 200-day above us, so I'm still looking for this to be kind of the low end of the range, and for us to break above this high end of the range for that push to 94 to 100, and I think generally retesting highs at some point this crop year. But it certainly isn't giving us much to sink our teeth into. And not much to say. I'm a broken record since like December. I've been talking about this range, and it's a range until it's not. So, I almost don't. I don't feel like we should get a test below the 83 area again. But if we do, it's just a range until it's not. But we've got upward sloping trend lines here that I think are worth watching, and certainly trying to build pressure against resistance. This market could go either direction out of this range, but I still favor a move higher at this time for various reasons that I've covered in the past, but not limited to, right, the high price of corn and beans relative to the acres for cotton, as well as just generally speaking, a gap and go situation that we've been holding on to for some time. So we'll see. Plus, I like cotton. What can I say? Dollar index to close us out today. I'll bring up gold and silver. Okay, we'll do those and the bonds. What can I can't forget all of this stuff. Dollar index has had a nice rally here, but I want to kind of keep everybody humble. We have really sold off. We are still holding downward sloping trend lines and some channel resistance for the dollar index here. We, in my opinion, really just traded back into the 55-day moving average there. 18-day moving average, certainly we've broken back above. 100-day is coming down, though, to do a cross above the 200-day. And we already had that 55-day moving average cross above the, or below, excuse me, the 200-day moving average and a bit of a death cross there. And, we haven't been, that hasn't been the case going back here since June of 2021, since we were back at 91. So the fact that from 91 we broke above and it ran us up to 114, now it's switching back below, that to me suggests that this whole trend is over and we could be swinging all the way back down to that 90 area. And again, the reason I say that is because the last time they crossed over, the 55-day wasn't below the 200-day since we were back up there at, almost 100. So the swing from 100 down to 90 was marked by that failed crossover, death cross, and the rally from 90 up to 114 was marked by a golden cross of the 50-day and the 200-day moving average. So, yeah, I don't know how else to put it, but I want to sell the rallies back to 106 in the dollar if we get them. However, I think we found our first resistance here into 104. As I was pointing out there, downward sloping trend lines and a bit of a trend channel right now. That 55-day moving average at 103 seems to be coming into play. And I also see what I refer to as an extended short here, but basically 2 steps forward, 1 step back, 2 steps down, 1 step up, 2 steps down, 1 step up. And we seem to be just, dead cat bouncing. So I'm not convinced on this dollar rally as anything more than a short covering rally that a move back to 106 to 105, the full 50% retracement of this decline. I'm interested in being a seller in the dollar. So the shorts might be covering in the near term, but I think the dollar ultimately is a sell for the better part and into the rest of 2023 as well. That's just because when you take a step back, I think the dollar has topped, and I think it's given us the daily topping signals needed to say that, right? This is just the next thing I do in the trend. We're not picking a top in the dollar. We didn't say we'd top at 114. Hoorah, hoorah, we got it right. We're saying we went up there, we pulled back, and now we've got signals for the potential pullback to continue lower. Okay. Gold, silver, and the bonds. Let's finish with that stuff, but obviously getting a little bearish on the dollar for a move now, either from where we are or from a little higher. What do I want to start with? Let's just go to the bonds. Upward sloping channel might be breaking here, so keep an eye on that with this move back below 127. Means just we're going to retest this 125 to 122 area. Certainly could retest the 116 lows, but yeah, okay, so if the dollar wants a correction here, this downtrend or this falling or the move back lower for the bonds here in the near term could be it. However, I do want to point out this downward sloping trend line on the continuation chart, or the daily chart here, daily continuation chart, we broke above it and we're trying to fight and stay above it. I don't know. I like the old support and resistance levels a little bit better here that we're kind of between 123 and 132. But all intents and purposes, we're still higher highs and higher lows for the last 2 months, and today is this month so far is an inside month. So basically what I'm saying is unless the bonds hold pretty much from this 50% from highs to lows, like right here, right now, we could just retest 125 and just be in a range. Now, that's fine. A retest to 125, this could be a corrective flat structure that does take us higher in the bonds, and that would be lower in the dollar very likely. But this makes sense. We're in a little bit of a downtrend for the bonds, hence a little bit of an uptrend for the dollar. We're going to continue to see that, I think, play out maybe for the next couple of days, but I think it's going to be a reason to fade that what people think is a reversal right now. So we'll see. Gold, 50% retracement, 116.18 or 16.18 lows to the 1975 highs. That 1800 area, I think we're coming down to it. This is a weekly chart for gold I've got up there right now. So taking a look at the daily chart, you can see Straight down over 2 days, dead cat bounce, trading to new lows for the month today. We're going lower. Next area of support is this old cluster of highs around 1850. I think we run through that. I think we run through the lows from our prior month. And I think we find some support down here at a max pain region at 1800 to 1750. This old kind of inflection zone where we fought through. And also, a little bit of a, love when my charts do these things to me. It's not great, but okay, forget it. Trying to draw a trend line, from highs to lows here. It's a little bit of, a retest of that idea. And certainly, anyway, point being is it's a 50% pullback nested inside of a larger 50% pullback for gold. And if we're starting a major trend higher, this is a very likely landing zone on a pullback that has now broken, once again, full 50% shorts off the highs. So just about every time, the market does that, you can look here at this period here. This is a pretty good example of one, I'm sure. Full 50% pullback finally breaks. Once it breaks, you start drawing up the full 50% longs. You get some kind of very big pullback at some point that gets some reaction or shows some support. At this point, it obviously broke through and we did a bigger pullback. But the idea is that this is a massive pullback from 2100 down to 1800, right? It's not going to be exact, but it was very close, within a couple percentage points is my point. If you have a big swing lower that gets a reaction, if that reaction doesn't carry through and gets reversed, obviously it invalidates the trade. But I wanted to show that even right in a situation where it invalidated it, there's always this kind of reaction from this area, and it's not always exact to the 50%. Sometimes it goes a little further towards the 618 line. Sometimes it's a little bit of a front run of it, but other times it can be, very exact. Like for example, there was the next in the series long. Wow. Anyway, there's a series long that broke here in the gold. That gave a pretty exact 50% short. Where was it? And in the S&P for that matter, all along here. And it at least gave reactions until, right, it eventually didn't. And that's what we're looking for. We're looking for those reactions in the market to then, make decisions over. Anyway, moral of the story is there's a chance now for pullbacks in gold to be bought. So I'm eager to see what happens here. I don't think we get super bullish the dollar, but who knows for certain, right? Well, that concludes today's Strategy of the Week update, everyone. I hope you enjoyed this week's session. Do leave your questions and comments in the sections below, and sign up for this webinar every week to get added to the mailing list and get the recording of it emailed to you so you don't miss it ever, because it won't always, this longer one won't always be on Facebook like it is being broadcast right now. It will be a private webinar soon with a little bit more to offer, with some interviews and doing some other things, which will be pretty cool. But with that being said, I will, we continue to do our Strategy of the Day updates. So your likes, your comments, and your follows are greatly appreciated. You can always get in touch with me over here at Zaner at 312-277-0110 for all of your trading needs to discuss the markets, or if you're looking to work with a broker like myself who can help manage your risk and trade plan alongside of you. You're the first mate, or you're the captain of the ship, and I can be your first mate navigator is the idea. Find me on Twitter, Facebook, or shoot me an email at dhussey@zaner.com. Have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone.